President Trump's administration is set to make a pivotal decision regarding the recapitalization and release of Fannie Mae and Freddie Mac, the two government-sponsored enterprises, GSEs, that play a crucial role in the U.S. housing finance system. This decision, expected within the next 90 days, could lead to the reprivatization of these entities, a process that began in 2019 when they were allowed to retain earnings. The Federal Housing Finance Agency, FHFA, and the Treasury Department, aligned with Trump's administration, are key players in this potential restructuring, which would involve converting government equity stakes and likely favoring junior preferred shareholders over common shareholders. The market anticipates significant changes, with junior preferred shares of Fannie Mae and Freddie Mac being recommended for their potential upside and anti-dilution protection. In contrast, common shares are viewed as overvalued, with limited gains expected due to potential dilution. The recap and release decision's impact on the housing finance market could be substantial, affecting stock valuations and investor strategies. The outcome will also have broader implications for the U.S. financial system, given the critical role these GSEs play in ensuring liquidity and stability in the mortgage market.
The recent downturn in oil prices, coupled with a weakening U.S. dollar and stagnating economic growth, is creating a challenging environment for markets and policymakers alike. As of May 21st, the S&P 500 has seen a slight decline of 0.6%, while West Texas Intermediate WTI oil prices have dropped by 14.5%. The U.S. dollar has depreciated by 8.2%, and U.S. Treasury bond yields have seen a marginal increase of 2 basis points, reflecting a 0.4% decrease in bond prices. This financial landscape is further complicated by a 0.3% contraction in the U.S. real GDP for the first quarter of 2025, signaling potential economic headwinds. The decline in oil prices is particularly notable, as it suggests a market adjustment to anticipated increases in production from major oil producers like Saudi Arabia, or the potential lifting of sanctions on countries like Iran or Russia. Additionally, the oil price drop is exacerbated by the falling dollar, which is unusual given that dollar-denominated assets typically attract foreign investors during economic uncertainty. The combination of a depreciating dollar and rising Treasury yields indicates waning foreign confidence in U.S. markets, a trend that could have broader implications for global economic stability. The Federal Reserve faces a challenging dilemma in this context, balancing its dual mandate of controlling inflation and fostering full employment, with the potential for tariffs to elevate prices while simultaneously dampening economic activity. The Fed must decide whether to raise interest rates to curb inflation, potentially worsening the economic slowdown, or lower rates to stimulate growth, risking higher inflation. This complex scenario underscores the current economic uncertainty and hints at a possible end to the recent oil production boom, as market participants may opt to leave oil reserves untapped amid these volatile conditions.
European stock markets experienced a positive upswing as U.S. President Donald Trump announced a delay in the imposition of a 50% tariff on European Union goods, originally set to commence on June 1st. The tariffs, now postponed to July 9th, have temporarily alleviated concerns within the European markets, leading to notable gains across major indices. The Pan-European Stoxx 600 rose by 0.99%. Germany's DAX increased by 1.68%, France's CAC 40 climbed 1.21%, and Italy's FTSE MIB advanced by 1.3%. This rally was particularly evident in the automotive sector, with major players such as BMW, Mercedes-Benz, and Volvo seeing their shares increase by over 2%, and Volkswagen rising nearly 2.5%. The tariff delay follows discussions between Trump and European Commission President Ursula von der Leyen, who emphasized the importance of the EU-US trade relationship and expressed readiness for rapid negotiations. While the postponement has temporarily eased market anxieties, the underlying trade tensions remain unresolved, suggesting that the upcoming negotiations will be crucial. The immediate market reaction underscores the significant impact of trade policy developments on investor sentiment, particularly in sectors heavily reliant on transatlantic trade. As talks progress, market participants will be closely monitoring any signals for a resolution or escalation, which could further influence European stock market dynamics and broader economic relations between the EU and the US.
Cardano, ADA, known for its robust academic foundation and eco-friendly proof-of-stake mechanism, is anticipated by investors to potentially reach the $2 mark by 2025. This projection is founded on its consistent development efforts, including the Alonzo upgrade for smart contracts and the Hydra scaling solution, which aim to enhance scalability and adoption. Despite its solid fundamentals, Cardano's price has historically been slow to rise, suggesting that while a 3x-4x return is respectable, it may not be compelling enough for investors seeking rapid gains. In contrast, Ozak AI, Ozak, a nascent project at the intersection of artificial intelligence and blockchain, is capturing significant investor interest. With a pre-sale price of $0.003 and over $1 million raised, Ozak AI targets a $1 price point, promising a potential 330x return. Its platform offers AI-driven financial insights and real-time analytics, appealing to traders and businesses navigating volatile markets. The project's low market cap and high utility potential make it an attractive short-term investment opportunity compared to Cardano's long-term growth trajectory. As 2025 approaches, investors face a choice between Cardano's steady gains and Ozak AI's explosive potential.
In a rapidly evolving crypto market, BNB, Cubetics, and Theta Network are making notable strides. BNB, the native token of the Binance ecosystem, is regaining traction, trading at $674.09 with a market cap approaching $95 billion. Its robust integration into Binance's trading and staking platforms, coupled with a deflationary token burn mechanism, maintains its position as a key utility asset. Despite its accomplishments, BNB faces challenges that newer projects like Cubetics aim to address. Cubetics, a leading contender in the 2025 crypto pre-sale market, offers a modular and interoperable ecosystem designed for real-world application across various industries. The project is in stage 36 of its pre-sale, with its $TIX token priced at $0.3064, attracting over 27,100 holders and raising $17.4 million. Early investors have already seen a 2,964% ROI, with potential returns reaching 226% if the token hits $1, and up to 4,794% if it reaches $15 post-mainnet launch. Theta Network continues to enhance its decentralized video streaming infrastructure, leveraging partnerships with tech giants like Google and Samsung. Its unique model, which employs a dual token system, Theta and TFUEL, aims to reduce bandwidth costs and improve streaming quality. By enabling users to earn TFUEL through unused bandwidth contributions, Theta presents a compelling utility with practical applications. The network's architecture, built on Theta blockchain and edge nodes, supports real-time data relay with lower latency, positioning Theta as a foundational player in Web3 infrastructure. Despite the competition from newer pre-sale projects, Theta's strategic partnerships and infrastructure focus secure its role as a valuable platform in the blockchain space.
McDonald's is facing criticism from customers and delivery drivers over a substantial increase in meal prices, particularly when ordered through delivery services like DoorDash. A recent incident highlighted a double cheeseburger meal, which with delivery fees, taxes, and tips, surged from its base price of $9.39 to $19.60. This price increase reflects broader trends in the fast food industry, where consumers have noted significant price hikes over the past few years. McDonald's, alongside other fast food giants, has faced ongoing scrutiny for rising prices, with some meals reportedly reaching as high as $18 for a Big Mac combo in certain states. The escalation in prices can be attributed to several factors, including inflation and increased operational costs for franchisees, as acknowledged by McDonald's USA President Joe Erlinger. Despite the introduction of value-oriented promotions like the McValue menu and $5 meal deals, the company continues to grapple with maintaining affordability amid economic pressures. The fast food sector is under strain, not only from consumer backlash, but also from delivery workers who argue that their compensation does not match the rising costs of meal delivery. As McDonald's navigates these challenges, it remains to be seen how effectively they can balance pricing strategies with consumer expectations and economic realities.
Miniso Group Holding Limited, HKG 9896, a Chinese discount retailer, experienced a significant decline in its stock price following its fiscal Q1 earnings report. The company's profitability took a hit due to a 46% increase in selling and distribution-related costs, largely stemming from its aggressive global expansion strategy. Despite this, Miniso reported a nearly 19% year-over-year increase in sales, indicating strong consumer demand. The stock is now down over 35% from its year-to-date high, presenting a potential buying opportunity for investors who believe in the company's long-term growth prospects. Miniso's management remains optimistic about the future, emphasizing their commitment to balancing growth with cost control. The company achieved its highest-ever gross margin for a March quarter, showcasing its ability to maintain healthy margins amidst challenging conditions. With a price-to-earnings ratio of around 15, which is considered inexpensive compared to the broader discount retail sector, and a healthy dividend yield of 3.38%, Miniso is focused on enhancing shareholder value. Wall Street maintains a buy rating on Miniso shares, reflecting confidence in the company's strategic direction and resilience.
D360 Bank, a pioneering digital bank in Saudi Arabia, has rapidly amassed over 1 million customers just 4 months post-launch, marking a significant milestone in the digital banking sector. This achievement highlights the escalating demand for innovative and secure digital financial services in the region. As a Sharia-compliant institution, D360 Bank aligns with Islamic financial principles, which may have contributed to its appeal in Saudi Arabia, where such compliance is often a key consideration for consumers. This rapid customer acquisition sets a new global standard for digital banking adoption, reflecting a broader trend of digital transformation within the financial services industry. The bank's success could potentially influence other financial institutions in the region to enhance their digital offerings to remain competitive. Moreover, the milestone could impact market dynamics, encouraging further investment in fintech and digital banking solutions, thereby accelerating the pace of financial innovation in the Middle East.
In 2025, the cryptocurrency market is experiencing renewed vigor, with several projects capturing the attention of investors due to their utility and growth potential. BlockDAG, a standout in the pre-sale sector, is generating significant buzz with its upcoming go-live reveal. Scheduled for June 13th, this event marks a pivotal moment for the project, which has already raised $269 million, securing its coin price at $0.0020. BlockDAG distinguishes itself with a no-code dApp builder and a visually intuitive dashboard, appealing to both developers and novices. The project's innovative approach includes buyer battles, a gamified pre-sale contribution system offering daily prizes, and has passed audits by CertiK and Halborn, bolstering its credibility. As it approaches its $600 million fundraising goal, BlockDAG is poised for exchange listings, making it a compelling option for investors seeking pre-sale opportunities. Aptos, another promising contender, is gaining traction with its high-throughput Layer 1 blockchain, backed by former Meta developers. Its ability to provide low-latency transactions and fast finality addresses the inefficiencies of older blockchains, making it attractive for developers and traders. Aptos's focus on scalability and safety, along with its developer-friendly Move language, positions it well for long-term growth as partnerships and DeFi applications expand on its network. Meanwhile, Bitcoin Cash is experiencing a resurgence as a medium of exchange, driven by its focus on fast, low-cost transactions and upcoming halving event. Its renewed integration with payment processors and relevance in regions with limited banking services underscore its utility. Lastly, Render is capitalizing on the growing demand for decentralized GPU rendering, essential for AI, VR, and 3D design. Its RNDR token facilitates transactions within its ecosystem, attracting creators and developers as the tech industry increasingly embraces immersive experiences. Together, these projects highlight the diverse opportunities within the evolving crypto landscape.
Dollar General, a leading discount retailer with over 20,000 U.S. locations, has announced plans to close 141 stores in 2025, including 96 Dollar General and 45 pop-shelf locations. This decision is driven by macroeconomic pressures such as inflation, shifting consumer preferences, and increasing competition. The closures, which represent less than 1% of the company's store base, are part of a strategic review to strengthen its business foundation. The company aims to to optimize its store footprint by closing underperforming urban locations and focusing on enhancing the in-store shopping experience and operational efficiencies. The closures come amidst a broader trend in the retail industry, where traditional brick-and-mortar stores face challenges from e-commerce and changing consumer behavior. UBS has projected that the U.S. could see 45,000 retail store closures over the next 5 years, affecting sectors like clothing, electronics, and home furnishings. However, Dollar General is also pursuing growth opportunities, planning to open 725 new stores and revamp its pop-shelf concept to attract more affluent customers. These efforts align with the company's strategy to adapt to the evolving retail landscape and maintain its competitive edge.